Welcome to the Capital News. I am your host, Alex Karitis. Today is Friday, March 20th, 2020. Thank you so much for joining me. Title of today's podcast is Stage Set for Inflation. This is a question, and we're going to talk about this. We have had previous discussions as to what type of environment we are currently in and where we are likely to find ourselves in the future. Of course, as I have stated here unequivocally, it is possible that you can have both inflation and deflation. It depends on the sector of the economy in which you are talking about. It depends on the goods or services in which you are talking about. Now, of course, inflation and deflation, in my opinion, and is the opinion of many other economists, not all, but some, that inflation and deflation is always and everywhere a monetary phenomenon. Now, the effects of that monetary jiggering around there with everything going on is higher prices, which we will call inflation, or lower prices, which we'll call deflation. Now, in many sectors, we are seeing right now deflation because demand is just drying up for everything. Nobody's shopping, nobody's out, nobody can do anything. Everybody's under quarantine to some degree, globally to some degree. So prices are coming down. You also have the demographic cliff that we have discussed here many, many times, and will continue to do so because it is front and center. It is discussed at length in our book, The Cynic's Guide to Investing, when we have our part and sections in that book when it comes to trends. Because if you want to understand trends, you have to understand demographics. You have to understand the purchasing power and the purchasing behavior of those particular generations and where those particular generations are on a timeline. Because clearly, your purchasing preferences will change over the course of your lifetime. When you're younger, you're more likely going to consume some sort of educational good, a college degree when you're younger as opposed to when you're in your 50s and 60s. Generally speaking, on average, you're going to buy your first home probably when you're in your 30s. Then you're going to go up maybe up to your second house, a bigger house when you start having a family, maybe in your 40s. Okay, by the time you get in your 50s, your 60s, you're pretty much starting to downsize, preparing for retirement, etc., etc. So your prime spending years are really, you got that bulk of the potato right there in the 30 to 55 range. Okay, after that, it starts to really peak, fall off. Some people will argue and show, statistically speaking, that it might be a little bit before that. But that's where your spending is pretty much going to peak, and it's downhill from there. Well, we have a large swath of the population here in the United States and globally, especially in the developed nations and developed economies, that have reached peak spending. And then you have your younger cohort, the generation following the baby boomer generation, being the millennials, saddled and riddled with debt. So this is a perfect storm. This is a double whammy because you're having demand starting to wane from the baby boomers because they're entering their twilight years, they're entering their retirement years, so they don't need to spend as much money, nor are they going to be generating the same type of income because now they're probably going to be living off of Social Security to a large degree. Maybe a pension if they're lucky, maybe an annuity if they bought into those, and whatever type of retirement savings that they were able to save over the course of their working lifetime. Okay, so their spending is going to start slowing down. We're already in the process of this. Behind them is the Millennial Generation. Again, saddled and riddled with debt. So it's not like they're going to go on a shopping spree and a shopping binge to buy up homes or cars or anything else for that matter that this country has grown accustomed to. And they've grown accustomed to it because that's what the baby boomer generation did. They spent. And of course, there was a lot of boom-bust cycles within that generation, within that process. You saw the dot-com bust, boom and bust, right? Huge. When it comes to the NASDAQ, you're talking a loss of 70 to 80%. That's depression-like losses on an index. Okay? Fast forward 7-8 years later, you hit the great financial crisis, triggered by the subprime fiasco. Fast forward to where we are today, after the longest bull run and largest and longest business cycle expansion in U.S. history. And now we're getting hit with COVID-19. We're getting hit now with a oil price war. And we're just getting hit with the business cycle being extended. Reaching its pinnacle, reaching its peak, that's it. It's now time to come down the mountain. And that is what we are witnessing. The bubbles have been pricked. You are not going to put the air back into it, despite the efforts that are currently being undertaken by central banks and governments the world over. And we're talking trillions of dollars that have been wiped off of the stock market globally, trillions. And now we have central banks and federal governments trying to flood the system again with trillions dollars more. Understand, that is what the government and central banks have been doing for the past decade to begin with, just not to such a degree in such a short time period. So these people who are at the helm, pulling on all of these levers of the economy through various mechanisms, somehow are of the mindset that the same policies that have continuously caused one boom bust cycle after the next, let's just continue to do those same policies. That is, by definition, insanity. There's no other word for it. At least not to keep it PG for this audience. They are doing the same song and dance, thinking it's going to work this time. And I have stated repeatedly here, since this podcast has been online for shortly over a year now, that my biggest concern for this market was always a question of when diminishing marginal returns was going to really kick in, and that the efficacy of any type of monetary policy was no longer going to be believed. Well, I do believe we have reached that point. It's Friday, March 20th. On Sunday of this week, I did a week ahead segment because the Federal Reserve had their second emergency meeting in as little as 2 weeks, and they cut interest rates by 100 basis points. They announced a quantitative easing schedule, a quantitative easing plan of $700 billion. They opened the discount window with greater and better terms for those who might come and seek assistance from the discount window. They completely removed the reserve requirement to basically keep some sort of cash on hand against deposits, completely gone, which allows banks to lend out as much money as they possibly can, basically infinity. This is ridiculous. And the markets did not buy it because they sold off like crazy on Black Monday Junior. And you could check out that podcast. This meeting, these emergency meetings that took place last weekend, were in lieu of the scheduled FOMC Federal Open Market Committee meeting that was supposed to take place this week on Tuesday and on Wednesday. And then the Federal Reserve, through the chairman, Jerome Powell, would come out and announce what their policy decision was. They couldn't even wait 48 to 72 hours to tell the world what their decision was. No, they had to have an emergency meeting over the weekend in lieu of their scheduled meeting, announce this crap on Sunday afternoon. Markets didn't buy it. They sold off drastically on Monday. And that sell-off continued because we gave back 15% this week alone, being the worst week since October, I believe it was, of 2008. In the heart of the recession, of the great financial crisis. It was only a few weeks ago, well, now about a month ago, where we were being told that this was the greatest economy ever. Now, if you had a solid foundation in the greatest economy ever, I don't think you would have given up trillions of dollars worth of quote-unquote wealth over the course of a few weeks. This just defies logic. Do not be stupid. And if you've paid attention to this podcast, and if you've been here for a while, you understand why. Because we don't listen to thunder thumbs. We do not listen to central bankers and any other type of cheerleader. It's fine to listen to them from the standpoint of understanding what they're saying. It's fine to follow their Twitter feeds or whatever they're doing to get their message out. But you have to look under the hood. You cannot just take these people at their word. And I'm not picking on Donald Trump per se here. This is any politician. This is any president of the United States for that matter. And it's any central banker. Period. Stop. No questions. And when you look under the hood, what do you see? Well, what are all those industries I've said to look into time and time again? And I hope you've done it because they're easy to find. You can go on the Federal Reserve's website because they aggregate this data from government sources, private sources, so it's easy to find. You can do it. We've done presentations on these in Capital Economics on our website at the Capital News. Check them out. But if you don't believe me, and again, don't take me for my word, go do your own homework. See it with your own eyes. Conduct your own analysis. You do not need to be an economist to understand the trend. Which way is the line going? Does it reflect against a recession or does it reflect against a time of booming prosperity? Very easy to see. Well, look it up. Construction, retail, manufacturing, industrial production, transportation, federal, state, and local tax receipts, corporate profits, jobless claims, etc., etc., etc. Put them together and what do you got? You have a messy puzzle that paints a nasty picture. And that is what I have been warning about for months. Again, a little over a year since this podcast has been online. Was the Federal Reserve, were governments able to continue to kick the can down the road? Yes, they were, longer than I thought possible, but they did it. But they did it, and it came at a cost, and it came at a cost of markets selling off with the rapidity in which they have done in the past several weeks, which is history in the making. And if you believe, as I do, that there was a bubble that was created during the entire tenure of the Obama administration as well, because there was anemic growth at best, which has continued under the Trump presidency, that it was all bought and paid for by central bank intervention and some heavy-duty spending at the federal level. All we have done over the past few weeks, folks, is eliminated the Trump bubble. And remember, candidate Trump was calling the 8 years of the Obama administration a bubble. And he was right. That's why I supported the man. I don't agree with his morals and ethics and his character and his language. But I didn't agree with any of that stuff when it came to Hillary Clinton either. And those were my two choices, weren't they? But at least this guy, Donald Trump, was talking about bubbles, was talking about the Federal Reserve pumping these bubbles up. That all of these numbers were a bunch of BS. So this guy might actually get it. Now he's in there and he wanted the bubble. He wanted Jay Powell and the Federal Reserve to cut interest rates. He still wants them to go negative. He wanted quantitative easing. Well, he got it. He got it. And look what it gave us. A melt-up. And look at the crash that came right after it. How many of you were truly diversified and vigilant? How many of you were able to protect yourselves? How many of you thought, well, this was just going to be a run-of-the-mill 10% correction, and then before you know it, it's 20%? How many of you are near or in retirement that still have savings in stocks, even in bonds or other financial assets? Did you protect yourself? Did you have cash? Because everything was on sale, and it continues to be on sale. And that's just the Trump bubble. What about the Obama bubble? I mean, I've been saying here for a long time, been on record, I said at a minimum, we are going to go back to 2016 levels. Well, we're almost there, because the Trump bubble has been eliminated. So we're pretty much there. Now we have the Obama bubble to deal with. That's 8 years. That takes us back to where we were in the depths of the great financial crisis. I hope we don't go that deep. But I wouldn't be surprised, because that's where all of this nonsense began. So logically speaking, it would make some sense to go back to those levels. Now, how fast we're going to get there, I have no idea. If we even get there. If we even get there. But this is what I'm talking about. So many people have been hurt. The baby boom generation, so many are nearing retirement. What are they going to do? Are they going to be able to retire? We talk about this at length in our book, again, The Cynic's Guide to Investing. because we talk about this societal and economic shift that this is going to cause. Because if you're near retirement and you can't afford to retirement, or you can't afford to retire, then are you going to? Assuming you can find a job? Assuming you can stay in your current job? No, you're not. If you can't afford to retire, you're not going to retire. So what does that do with the younger generations? What does that do with young people trying to enter the workforce? It makes it that much more difficult for them to find that job because there's somebody in that job or within that company who has years of experience versus somebody who doesn't. And if you're in a recession, maybe even a depression-like era or situation, and you're trying to make sure that you make it through it, what do you think employers are going to go to? You think they're going to try to stick with somebody who has experience, who can sort of weather the storm, who can actually maybe bring a steady hand and some context to the situation? Or you're going to go with somebody straight out of school who's never had a real job, so to speak? Now, maybe you say, well, from the cost standpoint, you can hire little Johnny, fresh out of school, for $40,000 a year, but you're paying John $85,000. That's a big difference, but what about that experience? So those are going to be some of the decisions that are going to have to be made as to whether or not you buy John out and say, okay, good riddance, we got to give Johnny a chance, or what's going to happen. This is what we've been witnessing. This is not just going to happen now. This started following the great financial crisis because these are huge generations, population-wise. The baby boom generation and the millennial generation. So it's going to be very difficult to swap everybody out, especially when the older generation cannot afford to retire. And the younger generation really can't afford not to work because they have so much debt from school. The cost of living is huge, especially if you're in an urban setting. The cost of rent, through the roof. Want to buy a vehicle, lease a vehicle, very expensive. Cost of living, very expensive. And then you have your student debt payments. If you want to try to buy a house is probably expensive. What kind of job do you have? Can you afford the house? So this natural process and progress of sort of passing the baton from the baby boom generation to the millennials is not happening. And sad to say, it's pretty much not going to happen. Are there going to be people that is going to take place? Of course. Of course. There's always going to be a handful. But generally speaking, in the aggregate, I believe that the baton passing is not going to take place. We're in recession. The question is, does it turn into a depression? So the recession itself is going to delay this baton passing process to begin with, just like the great financial crisis did, because we're still in the midst of that. If this turns into a depression, all bets are off. The baton's gone. What jobs are there going to be had for anybody? That's the problem here. And that could be why we are seeing such emergency measures being undertaken by central banks the world over, along with their respective governments. Trillions and trillions and trillions of dollars being thrown at this problem that they created. And we allowed it. We allowed it. We, the people, have allowed this. Nobody can wash their hands of this. Nobody. Because we've allowed this to happen. We are supposed to be a government of, by, and for the people. We're supposed to be a government of people, self-government. And these are the institutions that we have allowed to grow up around us and to continue with these insane and asinine policies. And now we all get to pay the price, no matter if you did the right thing, no matter if you lived within your means, no matter if you paid off your credit cards, no matter if you worked hard, put your time in, helped yourself, your family, your community, makes no difference. Everybody is going to pay some sort of price here. And with trillion-dollar stimulus measures just out of the federal government, it's basically akin to saying, well, our future selves are going to be bailing out our present selves. So do we need economists or do we need physicists? Because this seems to be more of a time travel problem now. Because the government doesn't have magical money. It doesn't grow on trees. It comes from somewhere, and it comes from the taxpayer. Well, if you're trying to bail out the taxpayer now, you see what I'm saying here? You see this circular logic? Who's bailing who out here? They're bailing themselves out, but with principal and interest. So how are you going to be able to pay this off? Oh, well, they'll tell you. There's going to be so much growth on the other side. There's so much pent-up demand coming on the other side of this. You don't have to worry about it. We're just going to be able to pay off $23, $24 trillion like that. Drop of a hat, flip of a switch, worry not. Well, that's where the question and the stage being set for inflation comes into play. Because there ain't no way on God's green earth we're going to pay this off through any type of growth. Because we're in recession. If we go to depression, it just kicks the can that much further down the road. People are going to be begging and screaming for some sort of government assistance, which is just going to exacerbate the problem, piling on even more debt, so it becomes that much harder to pay it off through growth. So how might a government decide to pay off their debt? Ever hear of inflation? Ever hear of hyperinflation? It exists, folks. It's what they do. It's not supposed to happen in a constitutional republic, especially not one like we have here in the United States, with the likes of Washington, Jefferson, Adams, and Franklin, etc. This is what you would expect in a banana republic. Hyperinflation that you might see in Argentina, or Venezuela, or Iran, or Turkey, or Zimbabwe. That's what we're talking about here. That's what we're talking about here, because there's so much debt. How is a government, any government, because it's not just here in the United States, it's everywhere. It's everywhere, which is why we're in the midst of perhaps the greatest depression. Most definitely the great unraveling, as we said here the other night. If this occurs, this is going to be severely detrimental on top of everything else that we're dealing with. Because to sort of have that hyperinflation take place, you need that springboard from a period of deflation, which we're seeing, because now cash has become king because everybody's selling everything, even gold and silver, right? We talk about that. People are looking for cash. They got to sell something that they made a profit on so they can cover their losses in the stock market through margin calls, etc., etc. The Federal Reserve has a dual mandate in this country. Full employment and stable prices. Well, if you're in a recession, depression, well, you don't have full employment. But if you have an environment where you have hyperinflation or even strong inflation, maybe we don't have to go that far with hyper, although it's likely. If you have strong inflation, that's not stable prices. So now the Federal Reserve's screwed. Because what do? People aren't working, so they can't check that box. And prices aren't stable, so they can't check that one. So what are they to do? If you wanted to try to get a handle on inflation, you increase interest rates. And if you want an extreme example, go back to the 1970s, when then Chairman of the Federal Reserve, Paul Volcker, basically created a recession by increasing interest rates to such a degree that would overwhelm the inflation that existed during that time period to bring it down. So what is the Federal Reserve going to do in this type of environment that will occur eventually? Will they increase interest rates to tame down inflation, which will just put a complete stop to any type of economic growth that might be spurring up somewhere because the cost of capital is going to be so high and you don't have people working, so there's no demand for anything? Get the problem? It's almost as if they're going to be creating a recession within a depression until all of this cleanses itself out. Not a pretty picture. Not a pretty picture. I hope I am wrong. But this is what I am seeing, given what they are doing. Not to mention that there are now discussions that the Federal Reserve Act might be amended, because the Federal Reserve is only legally allowed to purchase assets that have some sort of government guarantee. So treasury notes, bills, bonds, mortgage-backed securities, because they're backed by basically government-sponsored enterprises with Fannie Mae, Freddie Mac, etc. But now there are calls for the Federal Reserve to buy back or to buy corporate debt. There is also calls for the Federal Reserve to buy municipal bonds, state bonds. Well, what is that linked to? Pensions. Now the pensions are going to be bailed out. The pensions are going to be bailed out. You want to see what type of shortfall exists within the pension plan and all of these unfunded liabilities? Look it up. Go to usdebtclock.org. We've mentioned that here many times before. usdebtclock.org. It'll make your head spin. If you're not ready to be upset, don't look at it. This is just a joke. So what are we asking here? Are we asking people, Americans, that don't have a pension to bail out people that do? You don't need to be a political science major or historian to understand that this is not going to fly. An American loses his or her job, does not have a pension. Now, through their tax dollars, they are going to have to bail out an individual who does have a pension. You think that makes sense? You think that's going to work? This is why I get upset when it comes to student loan forgiveness. I paid mine back. Now you're going to forgive all of this student loan debt? I don't know if that's going to happen, but it could. We do know that there is at least a moratorium on the interest payments for, I think, the next 60 days the president has announced in regards to student loans. But what happens if it actually all just gets forgiven? One man's debt is another man's asset. Somebody is going to have to pay this bill. They didn't forgive mine. They didn't pay mine off. That was a lot of money. And had it not gone to paying off my debt, it would have been invested in the stock market that just went up drastically over the course of that time period. I can do the math. It would be a lot of money, and that's what I would want paid. Not just what I paid back, but what I would have earned on that money otherwise had I known, well, everything's going to be forgiven. So if you think a whole bunch of Americans who don't have retirement, that just got decimated, that are going to continue to get decimated, lost their retirement, lost their job, might lose their homes again, their cars, all this stuff. I hope it doesn't happen, folks, but that's what it's looking like, okay? Just to be perfectly honest with you, that's what I'm here for, all right? Don't have a pension, and now they're being told, well, the federal government's going to come in to bail out people that do have pensions? Oh, I don't think so. I don't think so. So when is this going to stop? When is all of this money printing going to stop? When is all of this stimulus and bailout mania and craziness going to stop? Because just yesterday we talked about this. Does money even matter? If you're just going to print it and give it to everybody, then what purpose is it? What's it going to do? Why not give everybody $1 million then and say, well, look here, that'll hold you over for a couple months, won't it? Why stop at $1,200 a month? Make it $1 million too. There are limits. You understand? I mean, how simple is it, right? You just take it out to the nth degree, multiply it by 1,000 like we just did. Oh, well, that just doesn't make sense. But, if we can keep it small, $1,200 a month or $1,200 for, one time, two times, we don't know. That'll do the trick, even though nobody's allowed to leave the house and buy anything. So I don't know what it's going to do. You're going to pay your landlord so he can pay his mortgage. So I guess, again, you're going to become a middleman to bail out a financial institution because your debt is somebody else's debt, right? You rent, that person has a mortgage on the building. So you got to pay rent so that person can pay the mortgage. You have a mortgage, well, go right to the bank. Got a car payment, go into the bank. Get my understanding here? See how the banks always get their money one way or another? Whether it's directly from the government, whether it's directly through the Federal Reserve or through a conduit, they get it. They get it. You lose your retirement, you lose your pension, you lose your house, your car, your job. But as long as the banks are made whole, everything's okay in the grand old United States of America. Yesterday, we also discussed the size of California because they have that government order from the governor, Gavin Newsom, basically a statewide stay-at-home order. And we said that California is one of the largest economies in the world. It's the fifth largest. It's the fifth largest, and it's basically on lockdown. New York is basically on lockdown, or will be. New York is also one of the largest economies in the world if it was standalone. Texas, while not locked down yet because of the coronavirus, it is basically on economic lockdown because of the oil price war. So you have three of the largest economies in the United States of America, which also are some of the largest economies in the world, on lockdown. What do you think is going to happen? How good do you think that's going to be for anybody? And these problems are not going to be short-lived. They're not going to be short-lived. People lose their jobs or they remain on furlough. I mean, just wait till we really start to get these numbers, unemployment, claims being filed, all of this stuff. It's not good, folks. And it's not because of COVID-19. It's because of all of the terrible policies that have been enacted under the past decade that are coming home to roost. Period. Don't let anybody tell you that this fiasco is COVID-19. It is not. It is not. COVID-19 was the pin that pricked the everything bubble. This is a convenient cover story for governments around the world and central banks around the world to say, oh, we were humming along, stock markets at all-time highs, everybody was doing great, unemployment at record lows, we had everything finally working. And then, a global pandemic comes out of nowhere, and it stopped us cold in our tracks. And they're trying the same song and dance again, and the market is not buying it this time, and they shouldn't. And they shouldn't. It's about time. But it's going to cause a lot of problems. It's going to cause a lot of problems. It's going to cause a lot of unknowns. I think, again, this is going to take years to bottom out. You know, the Great Depression lasted a decade, a little over a decade. I wouldn't be surprised if this one does as well. Again, I don't say this to upset or scare or be hyperbolic. This is just my analysis. You cannot have this much debt circling around the system in all corners of the economy, on household balance sheets, on corporate balance sheets, government balance sheets, central bank balance sheets, and thinking that everything is going to be A-OK. It's not. If debt and credit was the solution, then we wouldn't be experiencing this problem right now. But we understand what debt and credit truly is here at the Capital News, and we explain it to this audience all the time. And we have brought forward so much production and consumption, it's not even funny. So it makes logical sense that it's going to be years before we are able to truly come back to a period of organic, structural growth within the global economy. Are there going to be opportunities? Absolutely. Absolutely. There's always opportunities to invest, maybe in other parts of the world, emerging markets, if they can get their act together, because they have the stronger demographics. There's always entrepreneurs. There's always innovation. Human beings are creative. We will continue to move forward. Unfortunately, it's going to be the few, not the many. So there's going to be a big lag before the many catch up. And there isn't any type of governmental policy or monetary policy that can fix this. Free market capitalism can fix this, but it's going to be a process. It's going to be difficult. But there are no easy solutions here. If there is or was, hopefully I would know about it and I would explain to this audience what it is, but it's not going to happen. We do not get to walk away from generations, plural, generations of terrible policy and think that everything's going to be okay just because the market went down 30% really fast. I mean, that's just ridiculous. That's just ridiculous. I know you don't want to hear it. I don't want to hear it. I don't want to have to say it. But if you want to be prepared, then you have to understand what's going on. You have to have a little bit of everything. That's diversification, right? Some cash, some gold, silver, some bonds, real estate, whatever. You got to be diversified. You got to do what's best for you. Again, I don't give financial advice or investment advice. I give information. I tell you what I do or what I would do. You have to make those decisions for yourself. But I was prepared for this. If I wasn't, had I had been some other Prozac zombie walking around like 90% of this freaking country, I would have lost 20, 30% of my portfolio. I didn't. And I don't say this to brag or boast. I'm trying to help people. But this is ridiculous. At least I have a lifetime, hopefully, ahead of me to continue going. Even if I lost it, a lifetime to make it back. What about people who are in retirement or nearing retirement? How are you going to make it back? 30%. 30%. I can't think of what the amount would be for you to get back to even, but it would have to be somewhere around 40%. 40%. You would have to have a 40% gain just to get back to where you were if you lost 30. I mean, hell, if you lose 50%, you need 100% to get back. And 50% is sort of run of the mill in a recession, a deeper recession, which we are most definitely going to be entering. Talked about that bull trap. Again, there could be a nice big bounce, and people are going to say, okay, everything's fine. We got another V-shaped recovery coming, just like we did in the fourth quarter of 2018. Everything's going to be okay now. That's most likely going to be a big head fake. So again, be careful. If you're a trader, if you know how to, if you're nimble, if you know how to play that, good luck to you. But understand that's probably what it's going to be. It's going to be a huge bull trap, a huge head fake. Just setting itself up for the next leg down. And if you enter a depression-like era, you're talking declines of 60 to 80%. 60 to 80%. And then you can do the math as to how big of a return you're going to need just to get back to even. Now, hopefully you didn't hold on to everything during the entire collapse, but some people probably will because they just don't know what's going on. And then you have all of your stockbrokers and investment advisors out there. Oh, the market goes up, the market goes down. You just got to stick with it. Your time horizon, 60-40 split, stocks, bonds, everything's okay. Maybe you bought that for the first 10%. Yeah, we've seen this before. It's just a standard correction. That happens. What about the second 10%? What did your stockbroker tell you then? What about 30%? He tell you stay in, right? How does he get paid? How many people were warning you about this on Bloomberg or Fox Business or MSN or CNBC? Depending on the network, they're basically the mouthpiece for the Trump administration, which did you no good, by the way, because all of those miraculous stock market gains have been completely wiped out. Completely wiped out. Trillions of dollars on a daily basis being pumped into some market somewhere by the Federal Reserve, the ECB, the People's Bank of China, all the dollar swaps going on here because of the liquidity shortage in dollars. We talked about that the other day as well. All of this nonsense. Oil back at $20 a barrel. Huge whipsaw. Volatility everywhere. Bond market 10-year is back below 1% at 0.89% on the yield of the 10-year note. You don't see this type of volatility in these types of markets. Something is wrong. And when you have the Federal Reserve now at trillion-dollar repos, trillion-dollar repos on a daily basis. Remember, back in September, it was temporary. Somebody has failed. Somebody, some institution is failing. To me, there can be no other explanation. No other explanation. It could be a state. It could be a state. That's why there's talk of them getting into the municipal bonds. Who knows? I don't know. Nobody does. Maybe they do, but they're not going to tell us. Could it be General Electric? Could it be Boeing? Because let me tell you something, ladies and gentlemen, Boeing is nervous. Boeing is very nervous right now. And we've been talking about Boeing and General Electric for months, but particularly Boeing. They're nervous. They're in a lot of trouble. They squandered their profits. They squandered all that cheap money on share buybacks to enrich the executives. And now they're in trouble. They've been in trouble, but now they're really in trouble. You ready to bail them out? Tax cuts, deregulations, big member of the military-industrial complex, so they're awarded multi-billion-dollar contracts from the government in aggregate. You ready to bail them out? Because we're about to. What about the airline industry? Tens of billions of dollars in share buybacks to enrich themselves. Ready to bail them out? But the hotel industry. You understand that the stock market, most of the gains were, of course, on the back of the funny money printing and the share buybacks. Most other players, households, pensions, all these net, even foreigners, net, there's net outflows from stocks. The biggest buyer of equities over the past decade, this past cycle, has been corporations themselves. Zombie company after zombie company. How many of them are going to be bailed out? Where's the new management? Why does the old management get to stay? And why do they get to remain CEO, CFO, COO? Why do they get to remain on the board? Why do they get bonuses? What's going on here? These are serious questions. It's truly staggering. It's truly hard to believe. And that's coming from me. The Cynic's Guide to Investing. In the era of too big to fail, it pays to be a cynic. I mean, these guys have no shame. They have no limitation. Trillions and trillions of dollars for bailouts that are not going to be paid back. What about the big three autos again? We're going to bail them out because we know Ford has suspended their dividend. Ford debt was downgraded to junk months ago. Ford did escape bailouts last time, but there looks to be first on the chopping block this time. What politician from the state of Ohio, Indiana, Michigan is going to allow Ford to go under, right? So there's more bailouts. What about GM? What about Chrysler Fiat or whatever they are now? Right? Not just them. We have others in this country. Of course, they're foreign owned. So I imagine they'll be bailed out by their foreign counterparts too, whether it's Hyundai, whether it's Toyota, Kia, the German brands, Volkswagen, Daimler, all of them, right? Bailouts for everybody. Trillions of dollars countries don't have off of the backs of the working people. To bail out corporations who have enriched themselves off of the back of cheap money. This is the cycle. This is how it flows through the system. It's not rocket science. You just have to open your eyes and understand what's going on here. Because if you're going to solve a problem, you have to acknowledge that you have one first. And that's what we try to do here. So I hope you understand why I call for the Federal Reserve to be abolished and for the federal income tax to be abolished as well, as a starter. But again, the title of this podcast is Stage Set for Inflation. When you have $24 trillion in debt and climbing in trillion-dollar increments, there's no way we're going to pay this back through growth. None whatsoever. Especially when we're about to enter a recession and perhaps a depression. So that basically puts you out from paying this off 5, 10, 15 years at a minimum. So how might a government do it? Well, history tells us how they do it. Through hyperinflation. They just print it. They just print it. That'll be the springboard at a time when people aren't working, they have no jobs. So how are they going to pay for all of these things of prices that they just keep going up and up and up? Serious question. Even the other side of the ledger, the deflation side of things, can cause a lot of problems. Because if you have a business plan, a business model built off of certain costs, and now the product that you are selling is below that cost, now you're not making money. And that's what we're seeing across the board, particularly in the energy space, oil and natural gas. Because these companies cannot afford to pump oil and gas out of the ground and sell it at these costs and make a profit. Either side of the coin is not good, whether it's deflation or inflation. I don't know which one is ultimately going to win out net, but we're going to deal with both of them. There's no question. We're going to have both. How big, what dose, how long, don't know. And we won't until we're through it. But I can assure you that the more interference and the more intervention that is attempted by our pathetic leaders in government and in central banks, the worse the problem will get. Restore our constitutional republic. Restore free market capitalism. Enjoy your weekend, everybody. Who knows what's going to take place? Be safe. Be careful. Please like, share, subscribe. Get the word out for the Capital News. Leave your comments. We love hearing from you. Stay diversified, stay vigilant, and stay with the Capital News. I am Alex Karitis. Godspeed.